Let's talk a little more about the Fed and interest rates with an expert on the subject, Jim Grant. He's the founder and editor of Grant's Interest Rate Observer. And Jim, Kyle was talking about it, Kyle Bass, because of what Joe had heard from David Tepper yesterday. Tepper, who's made some big, bold market calls in the past, thinks that he would be a buyer of stocks here because he believes the Japanese are about to start buying bonds again. After selling treasuries for years, he thinks they're going to start buying again. I'll ask where you think treasury rates are headed. He thinks that will treasury yields, I should say. He thinks that will cap the yields that we've seen rise so rapidly. Where do you come in on this?
Well, David is a formidable character, and there's something to be said for what he said. My view, to take the very wide angle lens, is that we have been in a 40-year bull market in bonds. Almost no one living on Wall Street today has any recollection of interest rates rising. We are predisposed to assume that rates go down. That seems natural. These are the lowest nominal rates in 4,000 years. And to take a slightly narrower lens, they are remarkably low when adjusted for inflation as measured. Since 1962, you would get, as a saver, you'd get about 2.5 almost percentage points of real, as inflation-adjusted yield by owning the 10-year Treasury. Today, you get exactly no real interest. Inflation rate's about 150, 160 as measured. So the value proposition for the 10-year Treasury, to me, is absolutely barren. There's nothing to be said as an investment for them. And how often do we hear, Becky, that the 10-year Treasury is the most important rate in capitalism? Well, I think it's important to bear in mind, either the front of one's mind or the back, that it is an artificial rate. It's a manipulated rate. So the most important price in capitalism is corrupted. I think that's a fact of the first moment.
Which means what? You think at some point there will be no way to continue to manipulate it, and that's when things will spiral out of control?
Yes, I think that the Treasury rate is going to go up. I think it ought to go up to generate a proper return for savers. But I think more importantly, perhaps, than what ought to happen is what will happen owing to the imbalance of supply and demand. The so-called primary dealers, the warehousers of treasuries, are chock-a-block full, much more so than on average for the past 10 or so years. The Treasury's balance sheet is bulging. Almost no one buys this because he or she thinks it's a great deal. This is a security that's held by people who are price insensitive, and it certainly shows. And because it is a suppressed interest rate, it ripples throughout our capital markets. I mean, this whole idea of kind of techno-utopianism, that you don't have to have any earnings for a business. All you have to do is have a vision. This is facilitated, sustained by these artificially low rates. So I think that the 40-year bond market, bull bond market, is arguably over or ending. And what lies ahead of us is an important inflation with rising interest rates.
Jim, we're almost out of time, and this is really important. It sounds arcane, but if you're right, people should sell stocks because they're going to get much better deals, relatively speaking, in bonds than they have to this point, because it wouldn't just be the 10-year. You would imagine other bonds all across the curve would go, and not just treasuries, too. You're talking other bonds all related to this. If Tepper's right, you should buy stocks.
Well, I wouldn't be quite so broad brush. There are stocks and there are stocks. I think that interest rates have facilitated the overvaluation of the kind of stock, of the kind of business that earns no money, that exists on a wing and a prayer and a vision. Those stocks certainly are vulnerable to rising rates. Other stocks are going to do very well in an environment of rising interest rates and rising inflation, so one must distinguish. But I think that bonds as a class of asset are ought to be under the greatest suspicion. I mean, would you rather own a 10-year Treasury yielding like 160 or take out a 30-year mortgage at 3.25? It seems to me that borrowing at these rates is a much more compelling proposition than investing at them.
And that's certainly what we've seen. Jim, it's a longer conversation. We'll have you back because it's not going away anytime soon. We appreciate your time today.
Shepard Smith here. Thanks for watching CNBC on YouTube.